When picking your investments, there might be some questions that strikes your mind. What kind of returns can I expect from different asset classes? Do I need to choose one asset class or multiple asset classes? Investment lessons begin with the basics of different asset classes followed by a technique called asset allocation. This video will teach you to swim in the investment ocean. Welcome to holisticinvestment.in. In this video, let us look at what are the different asset classes and the importance of asset allocation. In the next video, we shall cover the other topics. First, let us look what is an asset class and what are the different asset classes. An asset class is a collection of financial products where these products have similar characters. Here, characters refers to risk, liquidity and return. There are different asset classes. Let us look one by one. Cash and cash equivalent. Cash denotes hard cash and the money you have in the bank savings account, which is mostly used for transaction. The problem with holding excess cash for a long time is that it merely fails to beat the inflation all the time. So investors are advised to have 6 to 8 months of their expense in the liquid cash always as a backup funds. Cash equivalents are short-term investment securities which has high credit value, generate returns and also has high liquidity. The cash equivalent assets can be converted into cash quickly. Some of the common cash equivalents are fixed deposits and liquid funds. Next, fixed income. A fixed income is otherwise known as a bond or debt. It works this way. Say the bank or a government or any private organization borrows your money and pledges to return the capital amount to you with the interest of about 7 to 8% for a predefined period of time. It offers 100% capital protection. So they are less risky investment with less interest in return. Example of fixed income schemes are treasury bonds, corporate bonds, certificate of deposit, debentures and fixed deposit schemes of banks. The actual return on fixed income securities is sometimes negligible or negative due to taxation and inflation. The third one is equity. Equity or stock is owning a small part of a public company. What is the first thing that comes into your mind when talking about the stock market? Risk. Of course, it involves risk, but the returns from the equity in the long term cannot be chased by any other asset class. You can expect a 12 to 15% year-on-year average return from equities. Equity is optimally a long-term investment. Choosing the right stock is very crucial in equity. Watching the numbers going up and down on a screen and all the time makes equity investment a nightmare for a commoner. Fortunately, this problem created the opportunity for the introduction of mutual funds. Mutual funds are less risky than direct stock investments. Here, the fund manager invests your funds in a diversified assets like stock, debt and gold, for which he charges a fee on the overall asset under management. For a newbie investor, it is advisable to go with mutual funds to avoid risk. The next is real estate. The value of your real estate investment is influenced by factors like accessibility of property, upcoming government project, transaction cost, potential demand, and political influence, and so on. Notably, the transaction cost is high while both buying and selling. Real estate investment lacks transparency in market price, land title and etc. So on, which might bring you inconvenience or legal issues in the future. Also, there is no substantial way to know the actual market price of a real estate. Apart from all these factors, the liquidity of your cash in real estate is almost frozen. Finding the right buyer on the right time at the right price is not a quick buck, which means the asset cannot be converted into cash immediately. Investment in real estate takes a lot of patience and more experience to generate good returns. Commodity. A commodity can be any type of goods like gold, copper, crude oil, silver, etc. that can be bought by anyone. But in terms of investment, gold is the most valuable and trading commodity and easily affordable commodity available in the market. India is always pleased about gold, but it is rather seen as a privilege than investment. Likewise, all the commodities have got their own characters and market influence. Now let's look what is the difference between investment and trading. The term investment in commodity is a contradiction. A commodity is for trading and clearly not for investing. The idea is simple about successful trading since ancient times is buy a commodity when the price is less and sell it when high. The major difference between investing and trading is that investment over time will generate more and more money by earning profit to both buyer and seller like in stocks, whereas trading will only swap the money between buyers and sellers pocket. The final one is alternate investment. There is a unique perspective of investment, such as collecting the state of art pieces like articraft, antique goods, and rare vintage pieces. Usually, the value of any commodity depreciates over time, while some commodities that are created with extreme care and passion end up to be the favorite one of that generation. This makes such a product more valuable with respect to time. But this is an unregulated market without any proper demand and supply. Return is unpredictable. With the right buyer, the return is huge, and without the right buyer, the loss may also be huge. A newbie investor needs an in depth understanding of the asset classes first, which I hope we have discussed enough. We, as a financial planner, always advise to invest in a diversified portfolio, that is, to invest in diverse products which do not respond to the market fluctuation in a similar manner. Now, let us look why we stress that asset allocation is important. It is pretty obvious for a common man like you and me chasing dreams in the chaos to be unaware of the concept time value of money. But you would have come across the term inflation. Inflation means that it reduces the value of money over time. A rupee today is worth more than a rupee tomorrow, which means you can buy a pen for rupees 10 today, but you may need rupees 11 to buy the pen next year. Investing is simply putting your money to work to beat inflation. So, if you are going to keep your money in a safe place, well and good. But in order to beat the inflation, always try to invest in an asset that grows over at least more than the inflation rate of the country, which is around 4 to 6%. The table here will give you a better picture. The nominal return of each class above the inflation rate is given here. You cannot blindly invest in a maximum return producing asset. We need to evaluate the risk factor before investing. So, the next is risk versus return. Basically, risk and return are proportional. Asset allocation is a principle of investing in a diverse asset classes and also investing in different financial product in the same asset class. This helps to balance the risk versus reward phenomena to minimize the volatility of your capital investment. The idea of asset allocation is to build an investment portfolio in a ratio that the criteria affecting one asset class do not affect the other in the same way at the same time. Remember the basics. If the risk is less, return is also less. As a risk goes high, then the return.
Liquidity. Liquidity is one more important factor to consider during the asset allocation process. In spite of holding high value assets, you may experience a liquidity crunch if such asset cannot be converted into cash within a short period. The money matrix we have created will be useful for you to have a better understanding. Mix of various asset class will solve the problem of liquidity. Till now, we have discussed the various asset class and why it is so important to have a diversified portfolio. In the upcoming video, that is part 2, we shall look into the art of asset allocation, how to create your personalized portfolio and how to rebalance it. And also a free downloadable asset allocation calculator will be featured in the part 2 video.
Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, Please subscribe now.